Bangla Pulse.
Okay, let's talk taxes. It's one of those things, right? Always complex, always necessary. We get asked a lot for clarity, and today, that's what we're doing. We're taking a deep dive, really getting into the weeds of the official charge and scope of income tax document.
Yeah, this isn't just about, the percentages you pay. This document is the blueprint. It lays out the legal foundation, how tax liability is actually structured, what counts as income, where the lines are drawn, especially internationally.
Exactly. So our mission today for you is pretty clear. Cut through the jargon. We want to give you the practical stuff. We're hitting two main areas. First, how the tax is actually charged the legal basis, plus some pretty surprising special cases and penalties.
And second, we'll look at the scope. How wide is that net? What exactly falls under total income? This gets really interesting when you talk about international deals and non-residents.
Okay, let's get into it then. Started right at the bottom. The foundation. What's the basic principle? How is the charge of income tax actually built?
Well, the core idea is actually quite straightforward, but it's powerful. The law states that income tax is charged, levied, paid, collected, all of it based on the total income of any person in any income year. That phrase, total income of any person, that's really the key.
Right, the master key. And the document doesn't just say tax is charged, it specifies how. It lists, what, 4 different ways this collection happens?
That's right. It breaks it down practically. You've got tax at source. It's like withholding taken before you see the cash. Then there's advance income tax, those estimated payments.
Keeps the revenue flowing throughout the year.
Exactly. And then minimum tax, and this catch-all phrase, any other tax. So it covers different scenarios.
Okay, so that's the general rule. But
Yeah.
almost immediately, the law carves out exceptions. You called it the special rate club before we started. What income falls into that?
Yeah, these are specific types of income treated differently. They don't get lumped into the regular total income calculation for rate purposes. Think capital gains, for instance.
Okay, capital gains make sense.
Mm-hmm.
What else?
Dividends, too. Income from dividends has its own path. And then there's a category for winnings, which is quite revealing about how the law keeps up.
Ah, right. This is where it gets modern. It's not just lottery wins or card games anymore, is it?
No, exactly. The text specifically includes money from winning a lottery, crossword puzzle, card game, and here's the update, online game, or game of any similar nature.
Online games. So esports winnings, big online poker tournaments, it's all explicitly covered now.
Absolutely. It signals that the source, the format, doesn't matter. If it's income from winning, whether it's digital or physical, the tax system has a specific hook for it. It bypasses the standard calculation, gets a specific rate, kind of simplifies things for these, irregular income types.
Right, exceptions to the main rule book. Makes sense. Okay, so that's the basic charge and the special rates. Now, what about enforcement? The document gets into some pretty specific penalties, doesn't it?
Oh, definitely. It's not just about assessing income, it's about policing the system. There are extraordinary charges designed to ensure compliance and, interestingly, to shape certain corporate behaviors.
Let's look at those. The first one that jumps out is about hiring non-citizens. What's the rule there?
Okay, so if you employ a non-Bangladeshi citizen in your business and you don't get prior approval from the government authority, well, there's an additional tax.
An additional tax. How much are we talking?
It's substantial. It's calculated as 50% of the tax payable on the employer's income or 5 lakh taka, whichever is higher. So it's designed to be a serious deterrent.
Wow. Okay, so get the paperwork done, basically.
Yeah.
What else? There's something about trade discrepancies.
Yes, Section 20 tackles trade and investment integrity. If there's a difference found between the actual value of an import or export transaction and what was declared, that's flagged.
And investment amounts, too.
Same thing. If the actual investment differs from the declared amount, in either case, trade value difference or investment difference, the penalty is a 50% tax on that difference.
50%. That's steep. A direct hit on any attempt to misrepresent figures.
It is. It's meant to ensure that the values reported are accurate. But then we get to Section 21, undisclosed offshore assets. And here, the penalties go to another level entirely.
Right, this sounds serious. What happens if a resident Bangladeshi has offshore assets they haven't declared?
If they own an undisclosed offshore asset and critically can't provide a satisfactory explanation for, where it came from, its source or nature, the penalty is frankly extreme. It's a charge equal to the fair market value of the offshore asset itself.
What, equal to the value of the asset, not just the tax on income related to it?
Exactly.
Mm.
Equal to the fair market value. It's essentially saying if you hide it, you could lose it. It's incredibly punitive, almost confiscatory. Zero tolerance for hiding foreign wealth.
And the tax authorities, the DCT, have significant power here.
Immense power. The Deputy Commissioner of Taxes can impose this penalty. They can launch onshore and offshore investigations if they even suspect an asset exists. And crucially, they can recover that penalty by confiscating or selling any other asset the person owns, even assets held by someone else on their behalf.
So even if the offshore asset itself is hard to reach, they can seize local assets to cover the penalty.
Precisely. The reach is expensive and makes the threat very real, pushing hard for full disclosure of global assets.
Okay, those are some heavy anti-evasion measures. But the law also seems to guide corporate behavior, especially for listed companies. Let's talk about retained earnings.
Ah, yes, Section 22. This is interesting policy-wise. For listed companies, there's a limit on how much profit they can just keep on the books, essentially. If the amount they transfer to retained earnings, reserves, or surplus exceeds 70% of the net income after tax from the previous year.
70% is the threshold. What happens if they go over?
They face a 10% tax payable on the entire amount transferred to reserves that year, not just the portion over 70%.
The entire amount. Wow. So what's the thinking there? Why discourage companies from retaining profits?
It's a lever to encourage distribution. The government is essentially pushing listed companies to either pay out more profit as dividends to shareholders or perhaps reinvest it more actively, rather than letting large amounts sit potentially idle on the balance sheet. It discourages, let's say, excessive hoarding of capital.
That makes sense. And that logic seems to connect directly to the next section, Section 23, about stock dividends versus cash dividends.
It does, absolutely. Again, focusing on listed companies. A 10% tax is applied to the whole amount of stock dividend declared if one of two conditions is met.
Okay, what are the conditions?
First, if the stock dividend declared is more than the cash dividend declared or distributed. Or second, if the company issues a stock dividend without distributing any cash dividend at all.
So the message is clear. Prioritize cash returns to shareholders. If you issue bonus shares, make sure you're giving out at least as much, preferably more, in actual cash.
Exactly. It disincentivizes companies from issuing stock dividends just to, say, preserve cash, especially if it's disproportionate to actual cash returns. It pushes them towards tangible distributions.
Okay, that covers the charges, the penalties, the behavioral nudges. Let's shift gears now to the scope. We've seen how rigorously the system tries to collect tax and penalize non-compliance. How wide is the net itself? What actually counts as total income?
This is fundamental, and it all hinges on residency status. For a resident person, the net is cast very, very wide. Total income includes, and I quote loosely here, all income from whatever source, whether it accrues, arises, or is received in Bangladesh or outside Bangladesh.
Worldwide income. If you're a resident, your global earnings are potentially on the table.
That's the principle, but flip that coin. For a non-resident person, the scope shrinks right down. Their total income is limited to income that accrues, arises, or is received in Bangladesh only.
A much narrower focus. Local scope for non-residents, global scope for residents. Clear distinction.
Very clear. And the law also prevents double dipping, so to speak. Section 28 makes sure that if income is taxed in one year because it accrued or arose then, it won't be taxed again in a later year just because the cash finally arrived.
Got it. Avoids taxing the same income twice, just based on timing differences. Now, actual accrual and receipt is one thing. But the really critical part for international business seems to be the deeming provisions in Section 27. How does the law decide income is effectively local even if payments happen elsewhere?
Ah, the deeming provisions. Yes, these are crucial. They're the legal mechanisms that say, okay, even if the transaction looks international on the surface, the economic substance is tied to Bangladesh, so it's deemed to arise here for tax purposes. It's how you tax non-residents properly on their local activities.
So what gets deemed local income? Let's break down some key examples. Employment income.
Right. If you perform the work in Bangladesh, the income is generally deemed local. But there's a specific rule for government employees. If the government or a local authority pays a citizen of Bangladesh for their service, that income is deemed local wherever they are paid. Abroad, at home, doesn't matter.
Okay. What about business activity and assets?
Income from a permanent establishment in Bangladesh or from any property, asset, or right located here that's deemed local. That's fairly standard. But the updates are where it gets interesting for today's economy.
You mean the digital economy aspect?
Exactly. The law explicitly states that income from the sale of any goods or services by any electronic means to purchasers in Bangladesh is deemed to accrue or arise locally.
So selling software online to someone in Bangladesh or providing a digital service,
hmm
even if your company has no physical presence, that income is potentially caught.
That's the intent. It directly addresses digital transactions crossing the border, ensuring they contribute to the local tax base, regardless of the seller's physical location.
And the definitions seem quite broad to prevent loopholes, like shares in local companies.
Yes, shares of a Bangladeshi company are deemed property in Bangladesh. But perhaps the most sophisticated part targets indirect transfers.
Explain that. That sounded complicated.
It is a bit complex, but important. It's as if you transfer shares in a non-resident company. So a foreign company, that transfer can still be deemed a transfer of an asset in Bangladesh.
How? If it's a foreign company's shares?
To the extent that the value of those foreign shares comes from assets that are physically located in Bangladesh, imagine a foreign holding company whose only real asset is a huge factory in Bangladesh. Selling the shares of that foreign company abroad could trigger Bangladeshi tax on the gain related to the value of that factory.
I see. It stops you from just wrapping a local asset in a foreign company shell and trading that shell abroad tax-free. It looks through the structure.
Precisely. It focuses on the underlying economic substance. And then you have specific payment types like interest, royalties, fees for technical services. These are generally deemed local if paid by the government or a resident.
Generally. Are there exceptions?
Yes. For instance, if a resident takes out a loan and uses that money exclusively for a business they operate entirely outside Bangladesh, the interest they pay on that loan might not be deemed local income here. The use of funds matters.
Okay. And insurance premiums were specifically mentioned too.
Right. Insurance or reinsurance premiums are deemed local income if they are paid by anyone, resident or not, to insure against any risk located within Bangladesh. If the thing being insured against the risk is here, the premium income is considered earned here.
Makes sense. It ties the income to where the economic value or risk is actually located.
So putting it all together, what we've seen is a tax system that does more than just collect revenue. It actively uses special rates, like for online gaming wins, which is quite modern. It employs really quite strict, sometimes even draconian penalties, especially around non-disclosure of offshore assets.
And it stretches its definition of local income, using these deeming provisions to capture value from digital sales, complex international structures, and services related to local risks.
Yeah.
It's trying hard to be comprehensive.
The underlying message seems to be transparency is key, compliance is enforced heavily, and the system is designed to tax economic activity tied to the country, no matter how complex the transaction looks.
Yeah, the penalties for non-compliance, especially the offshore asset rule and the trade discrepancies, are certainly designed to get your attention.
Absolutely. They signal that the cost of getting caught is intended to be very, very high.
So, thinking back to those corporate rules, we discussed the 70% cap on retained earnings and the 10% tax hit on stock dividends if they outpace cash payouts. Here's something for you, the listener, to consider. How does this clear push towards distributing cash now, rather than retaining capital for potentially longer-term projects, shape the investment climate? Does it maybe incentivize companies towards short-term shareholder returns over, say, long-term stability or ambitious growth financed internally?
That's a great question. It really gets to the heart of how tax policy can influence corporate strategy and capital allocation decisions. Definitely something worth mulling over.
Indeed. Well, that covers our deep dive into the charge and scope of income tax based on this document. Thank you for joining us and digging into the details.